The global financial system is a powerhouse, with 6.6 trillion transacted daily across markets, equivalent to 80% of global GDP in a single day. In India, the rise of 100 million retail investors, 60% of whom entered the market in the last 5 years, underscores the growing democratization of finance. Money is more than currency. It is a force of influence, behavior, and collective belief, amplified by 95% of trades now executed through high-frequency algorithms. Welcome to the intricate world of money and markets, forces that shape employment, savings, and long-term wealth. Yet these forces are increasingly volatile. What drives this instability, and how can we navigate it? Today's financial landscape is marked by uncertainty. Inflation at 6.2% in India as of June 2025 has eroded 30% of the rupee's purchasing power over the past decade. The Nifty 50 index, up 12% year to date, experienced a 5% correction in a single week last month, reflecting market volatility. Economic uncertainty impacts livelihoods, with 70% of Indian professionals reporting job insecurity in 2025 surveys. Traditional savings vehicles, offering 4% fixed deposit returns, struggle to outpace inflation, while 80% of new investors perceive the stock market as speculative, akin to gambling. This volatility raises a critical question. Are markets merely benefiting the affluent? The top 1% in India now control 58% of national wealth, exacerbating inequality. Several factors fuel this turbulence. Central banks, including the Reserve Bank of India, have expanded money supply by 10.8% year-on-year in 2025, contributing to inflationary pressures. Investors, seeking 20 to 30% returns in high-growth sectors like artificial intelligence and renewable energy, inflate asset bubbles. Global disruptions, geopolitical conflicts, climate events, and pandemics undermine confidence, with 65% of investors citing geopolitics as their primary concern. Corporate practices prioritize share price gains over innovation, exacerbating systemic fragility. Historically, 1 in 3 market corrections stems from a single destabilizing event. Yet a critical distinction must be made. The stock market is not the economy. It reflects collective sentiment. Even as India's GDP growth slows to 5.8%, markets can rise 15% annually, driven by optimism for recovery. This dynamic underpins the adage, buy fear, sell greed. Historical data validates this. Investors who entered during the 23% Nifty decline achieved 50 to 70% returns by 2021. The most successful investors maintain discipline, capitalizing on volatility while others react emotionally. Money and markets are complex but navigable systems. Understanding empowers informed decision-making. India's middle class is embracing this, with 40% now investing in mutual funds and SIPs, growing 25% annually. Wealth creation hinges on time, not timing. 80% of investment returns derive from long-term commitment. To thrive in this environment, individuals must prioritize financial literacy and strategic planning. Consider your approach. Are you leveraging the 12% growth in Indian equities, diversifying, or building knowledge? For deeper insights, explore our upcoming presentation, How India's Middle Class is Achieving 40% Greater Financial Independence. Engage with our content, share your perspectives, and subscribe to stay informed on navigating the financial landscape.